Welcome and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. On the program today, we're going to be talking about some smart moves and ways that we can actually take care of our money, especially since we've allegedly avoided that fiscal cliff. But then again, as you know, the feds keep printing money and decisions are continually made that kind of leave us wondering whether we should even invest our money anywhere at all. After all, we've got precious metals and gold that we're told is one of those great insurance policies that help us actually stay ahead of what is known as inflation, but with the devaluing dollar, who's to say? The book is The Aftershock Investor. Joining us here on the Beyond 50 radio program today is our guest, Robert Wiedemer, who's going to be talking with us how we can take a crash course in staying afloat in a sinking economy. I'd like to welcome to the Beyond 50 radio program today our guest, Robert Wiedemer. Robert, thank you for joining us here on the Beyond 50 radio program.
Thank you, Daniel. It's good to be on.
Now, this here is sort of a follow-up from your bestseller, Aftershock. Tell us about this and kind of let people know who may not be familiar.
In terms of what the difference between the Aftershock Investor and the Aftershock book? Okay. So basically, the Aftershock book focused a bit more heavily on the economics of the Aftershock. What the Aftershock Investor focuses on more is the personal finance issues, the obvious ones like stocks and bonds, but also life insurance, annuity, retirement issues, so forth. We have a chapter in there that summarizes the Aftershock book, and actually we also have a chapter that updates the Aftershock book since that actually came out, the second edition came out in August of 2011. So we update that book, we give you a summary, and then we focus the rest of the book, the Aftershock Investor, on various personal finance and investment issues.
Now, as people approach the subject of investing, because we all certainly take a look at potential retirement, hopefully anyway, a lot of people are finding themselves not in the situations they were hoping for, especially with what has happened in the last 4 to 8 years, or probably even longer. You know, what are some things that really people need to approach differently, because investing just isn't the same as it used to be?
No, unfortunately it isn't. It was a lot of fun, and it was great returns in the 80s and 90s when you could basically throw the darts at the page, as they said, the stock market page, and come up with a pretty good return. I mean, we were up on the Dow alone 1,000% between 1980 and 2000. On the NASDAQ, 2,500%. That's pretty good for the average. So it was good. It's not quite the same today. I mean, as we know, we're actually from our 2000 peak, we're down about 40% on NASDAQ, and we're kind of a little bit higher on the Dow, but overall it's been a pretty grim 10, 12 years. So it's not just that bothers me, though. It's more the fundamentals, which you alluded to in your opening comments about the massive amount of borrowing you're doing, the massive money printing we're doing to enable that borrowing. Otherwise, the borrowing we have been doing the last years would have already sunk us. But the borrowing, the money printing helps make that work at least for a while. It won't work for a long run. And that's why I've said, those basically that government borrowing and money printing are the two bubbles. I call them the government debt and dollar bubbles that are holding up the rest of the other bubbles, stock market, real estate, consumer spending, and private credit. So that means that we have some fundamental issues with stock and bond markets. Doesn't mean you're going to see them today, because those, again, pumping up the bubbles and the economy with the printing and borrowing works. But it means you're going to have to be a lot more careful about stocks and bonds in the future. And that, of course, is very scary to people because, they'll say, where else do we go? But it's still important to be aware that those markets could go down and could go down a lot, even if it's not this quarter or next quarter or even this year. But there's a real potential there at some point for a big drop. And it could be fairly unexpected and fairly dramatic because these markets are heavily manipulated. And I mean that in the sense that the Fed buys those bonds, manipulates that market, and certainly indirectly, that manipulates the stock market. So those types of manipulated markets often face a market cliff type situation, to key off the fiscal cliff term, but I think we also will be looking for that. So I guess first, be aware is my first word of advice on what we're heading for in the future, that stock and bond markets may be in for a big drop.
On the program, Robert, we've actually, talked about things such as value investing, which is one of the cornerstones of how Warren Buffett obviously has made his fortune, is by taking a look at things and kind of getting in when you can see the greatest spread on percentage rate returns. And, taking a look at that now seems to be, well, probably having some value. But again, you watch this dollar as we take a look at the Fed's always kind of throwing money to patch up situations that almost seem to be sprouting daily, if not weekly, and reducing what the value of the dollar is. So staying ahead of inflation, you literally got to be in a rocket ship. And, what do we do about something like that?
Well, I mean that is part of the problem. Is that even Warren Buffett, who is obviously a masterful investor, the reality is we actually looked at his returns in Aftershock Investor and kind of went through the fact that Warren really was we use the term bubble babies sometimes, people who sort of ride the bubbles and not necessarily through skill or great intellect do very well, but because the bubbles are going up. The reality is Warren's returns on his Berkshire stock were very high, especially in the 90s, but they haven't been so good since 2008, and even 2000 to 2008 were not nearly as good as before. So, value investing isn't working that well for Warren. But again, that's with a market that's stayed up pretty high, but that's also reflecting a market that's really gone nowhere in the last 10 years. So value investing, at least if Warren's running it, might work a little better than maybe typical throw the darts investing, but it's not necessarily all that good. Certainly not as good as it was in the 90s. And in general, when we look at investing, we don't look at it from a stock picker's mentality, which fundamentally that's what Warren Buffett is. He's a longer term stock picker, but he is a stock picker, and that's he picks his value stocks and he rides them. We don't come from that because we think overall, if the market goes down, it's going to hurt Warren too, as it did in 2008. Whatever kind of picker you are, it's going to hurt. Even high dividend stocks, which we like to some degree, like electric utilities, they all fell during 2008, and they will fall again if we have a significant downturn in the stock market. So we're a little less on the stock picking mentality, certainly long term, and more concerned about the market overall. To the extent we pick a lot of stocks today, I would be looking more at some higher dividend electric utility stocks, maybe some commodity stocks, and honestly, a number of strategies will work in a market that's going up 5 to 15%. It's what we're worried about is when it comes down again. So I think, again, just a little different outlook if you have that sort of aftershock longer view, is that the bigger problem is the overall market and not just picking stocks within it, because as we've seen in 2008, that fails when you have a big overall problem.
Now, you take a look at the American economy and the days when we were, strong industrially, we were certainly a manufacturing power. We created things and we made things, and it seemed to all shift outside of the country due to the cost of production and being able to sell goods at a reasonable price where consumers on average could buy these things. We're talking just regular working class people, such as being able to buy a car, the luxuries that may go on with coming to a house and so forth, to a society as a whole that became more of a services society, which is an interesting way to try to place any value on that. So what are we looking at here as far as the future of the way to really be able to approach this? Because, in manufacturing, it was about, being able to get things out on demand that were affordable. But, with the services economy, it just seems like we're pushing money around doing the same thing.
It does very much feel that way, especially I live out in Washington, D.C., and all I see are office buildings, row after row of office buildings. You wonder what the heck we're doing. I always tell people, we're what do we do? We're paper pushers. We manufacture paper pushing, and we push it all around town.
What is it that you do for a living? Well, actually, I sell insurance. What a coincidence. I actually do the same thing. Let's see if we can value this and make money off each other.
Right. So it is sort of, it's certainly in appearances, it can get a little frustrating as to where's the real value coming, but you point out a broader problem with the economy that we face is actually manufacturing has not only have we shipped a lot overseas, unfortunately, but manufacturing has actually done a pretty good job of improving its productivity. I mean, it's still been one of the better productivity improving industries in our country. Where we really run into huge problems is, as you said, that service sector in particular. 50% of our economy is made up of healthcare, education, government services, and that's where productivity productivity in our society and in our economy is lacking terribly. We just haven't increased productivity, and you could probably make a pretty good case we've decreased productivity in some of that over the last 30 years. So what we're going to have to do, as hard as it sounds, is you can't just drop healthcare or education. You're going to have to make it more productive, and so that's a real task. Just as we made manufacturing more productive over the last 200 years, call it, or agriculture, we're going to have to do the same thing with some of those service industries. Not saying it's easy, but that is what we're going to have to do, and I'm very confident we can do it and will do it. But that ultimately is the way you're going to have to get the economy moving. Certainly manufacturing we have to work with, and I think we have to do a lot more about getting fair trade. The aftershock will somewhat ensure that, as after that China will not be able to do this imbalanced trade. And that's also important, but we just can't overlook that we've got to improve productivity in those big service sectors, which take up 90% combined of our economy.
Mm-hmm. Yeah, interesting stuff here, because that's also one of those things that was pretty much pointed at as the blame of why middle-class America's faded. I mean, manufacturing was pretty much the cornerstone of how a person went from, let's say, going from the street to possibly becoming wealthy, is that you were able to cross through that middle section there, or be able to build from that middle section, which was very approachable. But now you see this, widened gap in this hole where people are scratching their heads going, well, what do we do besides maybe have a great jump shot, sell crack on the corner, or just plainly get lucky with a great idea like something like Facebook, for instance?
Yeah, and you can, and you're absolutely right. Manufacturing was very key to that. That said, you can also move up in the world in the service industry, and there is a way to move in the middle class through services as well. But to get to that broader issue you're essentially getting at, I'll put some numbers on that, about moving up into the middle class or above it. Between 1950 and 1970, real incomes in this country, adjusted for inflation, or real earnings, almost doubled. Between 1990 and 2010, almost flat. So almost no growth at all. And so that it's been some asset growth, certainly. We've seen stocks and real estate go up, but real earnings have not gone up much in that 1990 to 2010 period, again, versus a real boom, between 1950 and 1970. So that's exactly why people are feeling more stuck, and they aren't moving up. Manufacturing is definitely a part of it, but it's not the only way people can move up. We've got a broader issue there as well, outside of just manufacturing. But it is a real issue, as you point out.
Mm-hmm. Fantastic. To take a look at this whole thing and just kind of wonder, where does a person start if they just haven't invested anything at all? They know they want to get their money, because the big reason you find a way to invest money is to get your money to work for you when you're asleep, you're on vacation, it never gets tired, it never needs to eat. You put it in there and you get it to work, but it gets to a point, where do you decide to start with all of this, obviously?
Well, let's start with the first caveat. The 1980s and 1990s, where we got a lot of that feeling that you can put your money to work and it'll work for you all the time and make you a lot of money, was an unusual period. It wasn't always that way. We have certainly had periods where we've had down investment periods where people lost their money. There is a time in any economy, and we've seen it before, where you should just be on protection mode. And I'll expand on this in a minute, but for example, Charlie Merrill of Merrill Lynch, the one who's bullish on America, said in 1928, everybody out of the stock market. It's gotten too frothy. Now, he was early in his call, but he was obviously right longer term, and he didn't say get out of this stock market and into that stock market or this other investment. He was pretty much saying get to the sidelines, and there can be a role for that. You may not always be in a situation where your money can make money easily. Now that said, I think you can make money. I said in this book that I think some of the greatest amounts of money ever made will be made in the next 10 years, but for retail investors, it is going to be a little bit scary, as any real investment is, and it's also a bit difficult, again, as any real investment. It's not like throwing darts at the stock page. Mm-hmm. And some big suggestions for right now, we've been big fans of gold. We're not gold bugs, but we found that, gold's up now. It's 12th consecutive year, up, over 400%. And that's actually an amazing investment. If you think of that kind of increase and never having a down year in 12 years, that's pretty good.
Mm-hmm.
I think gold will, it closed up last year about 7%, the year before about 10%. I think we'll do, reasonable 5 to 10% this year. And there's a big upside potential that it could jump out and do quite a bit better. Like any investment, of course, it could also go down. But I think overall the fundamentals support it, the fundamentals of the money printing, the fundamentals of people getting nervous about all other investments, stocks and bonds. Again, any given time, it certainly has shown volatility could go down, but I think it's something to consider as part of your portfolio. We also like something, I guess, on the other side that everybody would agree is much more conservative, but frankly, it's also performed well, is TIPS. With inflation expectations going up, TIPS, Treasury inflation-protected securities or inflation-protected government bonds have done quite nicely last year. 4 to 6% growth, and I think we'll see a certain amount of growth this year, and certainly less volatility and more what you might call mainstream safety than say gold. So those are a couple of the things we like. But we'll see how stocks go this year. I think my main concern over stocks and bonds. Bonds, we all know, have really, we've been in a 30-year rally, and it's coming to an end, but any 30-year rally isn't probably going to come to an end overnight. It's going to be over a longer period, and, bonds could still go up in value, or yields go down and bonds go up in value. I'm not saying I'm not calling a peak in bonds or in stocks, but I think that increasingly over the next year, the upside potential will be more limited and the downside risk is higher. And so I would keep that in mind when getting involved in those, although you certainly could make some money. I would tend to be, certainly for the over 50 crowd, a little bit more defensive in that I would get shorter-term bonds, or as I said, I like TIPS, which are inflation protected, although longer term they can be 10-year or 20-year TIPS, but still, because of the inflation protection, they're pretty good. Or the more defensive stocks. I still like this year. The utilities didn't do as well last year, but I think electric utilities will do reasonably well this year, and without quite as much downside risk. So that's sort of it's hard to say exactly where you start investing, but those are some of the things we like. But we do tend to be a bit more conservative right now, given what could happen. And we think preservation of capital can be very important. It's not always possible to make 5 to 7% a year. Although again, I think there are some ways that you can certainly make some decent money now. But they're a bit unconventional. Gold is unconventional. Even if talked about a lot, it's still an unconventional investment.
Well, we do know that one of the big bubbles that busted was the housing bubble, and you can almost see the problems occurring. I remember as we began the radio program 9 years ago, you were seeing mortgage companies. We were just infested with them. It would be like going to Tennessee and seeing lawyers. I couldn't believe how often we were being approached to be able to we could have just plucked advertising revenue off the street. It was falling into our bedroom almost, and it was all about mortgages. Everybody was a mortgage broker. Now, all the people that I knew who were mortgage brokers are completely out of the business and have been for at least 3 years. So we know that that's kind of behind us. You don't see the mortgage companies around like you used to. I mean, they've become ghosts almost. Now, you have to take a look at something like that, did exist. What are other bubbles that are occurring now that people should be aware of that look like, boy, this is something to get involved with, but it might just be at that point where it's about to burst as well?
Well, a couple things. Housing itself, in certain parts of the country, housing has rebounded. Miami they're actually building condos in Miami now, which is rather amazing. They've had a huge inflow of Brazilian money into Miami, and condos are starting to pick up. Places like Phoenix as well are picking up, and maybe even parts of California, certainly, and parts of San Francisco never really went down that much. Not the Bay Area, but certainly the main city area. And they're doing well. So they're, I think there could be a run for that for a while. Not, it's not necessarily going to reverse this year. But when you're buying housing, it's usually a longer-term commitment. But, that said, if you could go in and go out quickly, maybe so. But that's a bubble, to answer, to what you wanted, that I think could go over quickly. We all know, as I said, that the bond bubble, I think, clearly has been, is getting tired, but could go a ways more, but is going to turn. That's talked about a lot, and I certainly agree with that. Bill Gross has made many statements on that. Of course, I think Bill's a very smart guy, but it always begs the question: if bonds don't work out very well, what the heck is Bill Gross going to do with his $1 trillion worth of bonds? But it is that is another bubble, I think, that is coming to an end, but may have a little ways left to run. So those are a couple of them. China, I think, it's got a very bubbly economy, and I think it's going to bust sooner or later. It could be later because the government can always manipulate it a little bit more, but that's going to have some impacts on a lot of areas, especially on the West Coast, and but the rest of our country is certainly going to be affected by that, and less so than maybe the individual ones I was just talking about, housing and bonds. But those are two I'd be looking at real closely for right now, and then internationally, definitely China. Those are the kinds of things that still are, I think, a little bit bubblish, but could go. But let me also say again, overall, I don't think that the original stock and housing bubble busted as much as it would. It went down, but again, we pumped up those airbags of money printing and borrowing that have helped keep them up. And when the money printing and the government debt bubble busts, those will pop as well. Those stock, real estate bubbles that we boosted in 2008 will come down again.
It just seems when you take a look at the strategy the government uses, print more money, throw it in there, as you said, inflate the bubble back up for a while, until it seeps or breaks, whichever occurs first. Whether or not there would just be a different strategy, a new way to approach the whole way of commerce and economy, and, are we just too caught up in doing things as we've always done, or do you see that there's this possibility that we're just going to have to eventually change the way things are done?
Well, I think we absolutely have to eventually change the way things are done. That's what this means, and I've often said that that we're at least from a governmental standpoint employing the wall strategy. I mean, I think we're going to keep going one direction, and we're not going to change until we hit the wall and we're forced to change. And other people, not just me, have mentioned this. Jamie Dimon, CEO of J.P. Morgan Chase, has said kind of the same thing recently, that at some point the bond markets could revolt. And so you've got a point where this thing, you're not always in control. I mean, imagine many companies or many individuals, as we know, go to a point where they just go so far they declare bankruptcy, and that happens in the real world. You're forced to change, and I think we will eventually be forced to change too, both in the way we invest, but also in the way we run our economy and the way we run our government's finances.
It's always a fascinating topic because it seems that there are just as many opinions almost about how and why this works and does what it does and what you should do and what you shouldn't do as there is dollars being printed to be able to do anything with. And it can really leave a person, hearing many whistles like a dog trying to figure out which direction do we go. Now, one of the things that was really fascinating that here we just had our most recent presidential nomination and then election, but again, here we faced one of those crises, such as when George W. Bush went out of office. We're asking for $700 billion because we just now became aware of a major mistake that we've allowed to go on for too long, and this is going to possibly cause the world economy to crash if you don't just let us take this money from you and do these things to bail these people out that have been doing this in the first place. So, of course, lots of investors lost lots of money. Most of them were just average people and 401ks and IRAs that their companies were sponsoring to them, where people were just taking the money and using it any way they wanted to and getting them into really sloppy investments that, of course, lost money. And now people will find themselves continuing to work for years to come, maybe just for good until they find themselves 6 feet under. Just recently, here we go, another presidential election. Oh, by the way, we've got this fiscal cliff now that we're about to go over. And I found that really amusing because it seems that whenever these things occur, and it seems to be, right as an election is occurring, get the guy into the office and see if they can get in there fast enough to solve this problem. I said, you'll watch. This is a typical government thing. This fiscal cliff is going to be resolved if we can understand what it really is in the first place. And right at the 11th hour, sure enough, it works itself out. And I kind of wonder, it's interesting to look at these things because you think, okay, the government seems to bring this problem up that could have been there the whole time, but then they make it, really a problem. Then they solve it at the last hour so we can go, woo, our government is really protecting us. We wouldn't be there in the first place if they were doing their jobs.
Exactly, and that's what it is. This stuff wasn't unknown. We had big problems before. Right. They always say that we're going to have a big crisis, but in fact, the government can always borrow more money. Looking across the pond, as they say, they're always worried about Europe imploding and all this, and certainly its economy continues to implode, but I wasn't as worried about the euro as many people were, simply because I knew they could print money. And that's the kind of one-out government has. And that's also the way that we get these problems, as you're saying, that people don't recognize early and then blow up later, is I can tell you the printing money is not money from heaven. It's going to blow up later. But everybody's, but it's helping the markets so much. How can it be bad? It's no inflation now, so it must be, fine. And that's kind of like housing. When housing's going up 20% a year and incomes are only going up a percent or less, give me a break, guys. And, as you said, all the mortgage things, that was, they don't talk about it. Half the reason the post office is having problems now is you don't have all the, crazy mailings from the mortgage refi companies and the credit card companies and so forth. Although some of that's coming back. But it was way out of control. We could all see it. We just all hoped it would work. Just like today, we can all see it. The government borrowing is up 600% annually since 2000. 600%? Over $1 trillion. I would have thought, if you told anybody we're going to borrow $1 trillion, in 2001 or 2000, well, one, they would have thought we had a balanced budget by now. Two, they would have died. And so I think we all see it, but we're kind of trying to avoid it. We all hope it works. We all hope that what we're getting out of that is sort of for real, rather than a bubble. Again, whether it's real estate or internet stocks, we know the mentality. And I think that's why we get into these problems, is that we like it as long as it's working, and when it stops working, then we're all upset. But it shouldn't have come as any surprise that things blew up in 2008. It shouldn't come any surprise that the massive printing and massive borrowing is going to blow up as well. If for no other reason, when heavy hitter economists talk and support it, I always ask, well, guys, if this is such a great idea, why don't we just do the Wiedemer stimulus plan, which is get rid of all taxes. Democrats, Republicans will both be pleased. I'll get rid of Social Security taxes, corporate taxes, individual taxes, all gone. We'll just borrow every single penny. Mm-hmm. And if we have trouble selling the bonds, Federal Reserve can buy them, right?
Right.
They don't create inflation. And people kind of know that, no, you're right, this can't really work. But until it's sort of proven, right now they're getting the upside of it, until you get the downside, people probably won't change, just like the housing bubble. As long as they're getting the upside of the bubble, they loved it. Right. Once the downside goes, well, then we all realize how unrealistic it was to think the upside was real.
And it brings us to really a question now that emerges, Bob, and that is this value. You take a look at this whole thing and you decide, who decides what the value of all of this is? Now, getting an idea behind this, you alluded to gold earlier, and it's been talked about that, that is sort of what they call investment insurance, because gold has this way of sustaining itself and even growing as money, as inflation goes up, it seems so does gold, okay? So it seems to be sort of a good investment insurance, if you will. But what's funny about that also is there seems to be a lot of companies that sprout around this that actually buy and sell gold and silver. In fact, a friend of mine was just recently involved within the last couple of years in a company that was part of almost like a network marketing distribution company that bought and sold gold. And my question was, well, when you buy this gold from this company, in these little chips, certificates, whatever the case is, do you have to sell it back to the same company? And do they really sort of govern what the value of that is at any given time? So it kind of left me with a question. If I was going to buy gold and silver, where would I go to do these things, and what are some things that I should watch out for? And that being said also, then we also deal with the ideal of precious metals that I've heard is also sort of one of those insurance policies, mining stocks, things like that. From this point on, as we're getting close to the end of the show, what would you like to recommend to our listeners, to get started, to be aware of when it comes to basically becoming the Aftershock investor?
Sure. I would, again, first of all, be aware that the stock and bonds are in a bubble and could pop. Doesn't mean they'll pop this year, but don't think they're going to go up forever. And they haven't. The last 10 years have not been great for stocks, even though they rebounded. So, be ready to move out. That's the bottom line. I suggest earlier rather than later. Most people will tend to be a little later, but just be aware that these could have big long-term problems. So second, for things to buy, as I mentioned earlier, tips I think are a very nice investment. To the extent you want to stay in stocks for a while, electric utility companies. Right now I'm not big on currencies or even some commodities. I think for most retail investors those are a little tricky, and I think there's some short-term issues with those. I do like gold. You can buy those as an ETF, which is you can buy them in a Schwab or Fidelity account. I'm not as worried about ETFs as many people are, although those who are worried about ETFs tend to like, ETFs kind of like PHYS or GLD, more PHYS. Those are one set of ways to buy gold. If you buy gold on a retail basis, I tend to want to buy bullion gold, 1 ounce coins. Don't buy proofs or things like that have a big markup. Stick more to bullion coins. 1 ounce are the easiest to trade. They tend to have the lowest markup. So I like 1 ounce bullion coins. You can buy them from local coin shops. You can go online on the internet and probably get even better pricing than the local coin shops. There's a variety of people who sell these things online. And just take a look and compare prices like anything else. Do some price comparison shopping. See who offers the best, and that's one good way to buy it as well. So there's a number of ways you can buy gold. There's certainly other normal, as I said, stock and bond type investments, meaning tips. There's ETFs for tips that are very good. Those are the kinds of things I tend to like right now for, primarily protection, but also a bit of a potential profit as well. But as I said, don't be afraid for a while, just to be a little bit more concerned. Everybody may feel like they're missing out, but that's the way people felt in the housing bubble too, and then some people jumped in 2005, 2006. It didn't turn out so well.
The book is The Aftershock Investor. Our guest today, Robert Wiedemer. Can you please give out the website for our listeners to be able to find out more about this?
Sure. It's pretty straightforward. Aftershockpublishing.com. Aftershockpublishing.com. It's got all the information on the books and everything you'd want to know.
Thank you so much. It was a wonderful conversation to find out more about what we can do and probably maybe apply a little bit of common sense if we have any left. Thanks again, Robert, for joining us here on the Beyond 50 radio program.
Thanks, Daniel.
I want to thank you, the listeners out there, for tuning in. Again, just find out about this at Aftershock Investing, and you can find out more about that. Also, be sure to visit us at our website at beyond50radio.com as well. Thank you again for tuning in. I'm Daniel Davis, and remember, live your day past